and then I'll let them in. All right, so tonight we'll be pretty straightforward. This is just at a point where I think you guys have enough information, and now it's time to kind of like stop throwing blank darts at the chart, right? And so what I want to talk about is, and actually show examples of, is basically defining how you're gonna wake up and approach price, given the model that you choose. All right, and I've sent some of you those ICT models, the models 1 through 12. I know it's a lot of information, but what this is, and the reason I sent you guys that stuff is because I wanted you to see how there comes a point where you have to kind of condense, find a way to condense the things that you know, and then package it and wake up and have a narrowed focus every day, as opposed to waking up and just looking for random things and then trying to apply what you know, right? We're human, and it's better if we can make investments behind the premise of something that becomes kind of like second nature or automatic, right? We're waking up and we're seeing the same thing. We're looking for the same thing. We know what time it's going to happen. We know what manner it happens in, which day of week is it more prone to happen, right? And so let's kind of define this, and you guys have had enough time to kind of figure out which session you want to trade. Some of you trade both sessions, right? Which, you know, I would honestly say to choose one. Just choose one. Just choose a 2 to 3 hour window, right? Rather it's London Open, New York Open, right? And then we're going to talk about this overnight build, and we're going to talk about balanced price ranges a little more, and how we use that in regard to this macro. All right, so we're going to bring that macro to life. All right, so for starters, let's talk about the London session. All right, so in London, we know that, I'm sure you guys have heard me say, hey, I'm gonna trade, I'm gonna wake up for London tomorrow. And you already know I'm only looking for one thing, right? London for me is, if I ever wake up for London, which is not often, I'm only looking for a Judas swing, right? That aligns with a particular narrative that is already preset within the market. All right. So as traders, we want to now define, like, what is our shift, right? When do you show up to the desk? All right. And when do you leave the desk? So for London, the most optimal time is this time period between 2 a.m. and 3:30, right? And then there's usually a 30-minute hangover that you can give yourself, which would run us until 4 a.m. All right. The stage. All right. We talk about our stage. So the stage in this case, hang on one second. Nobody joined, right?
I don't think so.
Okay, cool. So the stage, all right, is, and honestly, it's going to be the same pretty much for both New York and London. But the stage is, we want to be trading in line with higher time frame institutional order flow, right? And of course, if we're trading those Judas swings, then of course we understand, right? You understand enough to know that the Judas swing should really oppose the higher time frame order flow, the Judas swing itself. And then, you know, if we're in a bearish side of the curve, sell side of the curve, then we know that Judas swing is going to be here, and then we're going to get that, right? So we want to trade in line with higher time frame institutional order flow, right? We also want to be trading in line with the weekly range expansion. All right. typically more times than none with the Judas swing, right? That move is more times than none most apt to happen maybe Monday through Wednesday, but that doesn't mean you can't trade it on Thursday or Friday. I'm just saying right here, we know that that move is more, we're going to see it more within these 3 days. All right. But that does not mean that you can't trade Thursday and Friday. We just want to highlight those days. All right. And then we want to know, right? Am I on the buy side or the sell side of a curve? All right. So we need to know, right? If a buy or sell program, which side of the curve am I on? What did I write from? All right. So that's our stage. Now the pattern, all right, is the Judas swing. This is important because when you wake up every single day, you already know, right? And before you go to bed, or you know, maybe you're not waking up, maybe you're just walking into light and open, but you already know it's preset what you're looking for. You already know I'm looking for a Judas swing in line with the weekly range expansion, the previous day's draw of liquidity, you know, so on and so forth, right? You already know exactly what you're looking for. You know what that pattern looks like. And then you become a perfectionist and a master at that pattern. And we're going to look at price action for, me and Matt did this last week. We're going to look at price action and pretend that we have already defined this as our model, and we're waking up as a trader every day, and this is all we're trading. All right. And you're going to see something special that, you know, should spark some type of insight. All right. But that pattern is that Judas swing. All right. And just to draw that Judas swing out, which everybody already knows, we have our midnight open. Right. More times than none, price will give us a slight inducement. All right. In the perfect world, it'll give us that little move here, protraction at midnight. And then we run up, Judas swing, maybe taking out Asia or maybe not taking out Asia. And then our entry model comes, right? And then expands in line with the higher time frame institutional order flow. All right. The look back function for this, or the look back range, right? We're gonna be looking at the central bank dealers range. We're also going to be looking at the Asian range. All right. And then we're going to be using standard deviations. Okay. Everybody clear on that? Anybody have any questions about this so far?
No, it makes a lot of sense.
Okay, cool. All right. So we'll go to price action, and we'll look at last week, and we'll see, like, if you were waking up and that's all you were focused on, right? And you're decluttering the mind, and you have a strict focal point. So let's go here. All right. All right. So coming into last week, we already know, everybody knows higher time frame order flow. We don't have to go through that, right? We've saw enough weekly breakdowns and things of that sort. We know that we're on the sell side of a curve, right? We know that that will be our stage, right? We know what time we're showing up to the market, all right? And we know what time we're clocking out, all right? We know what the weekly range expansion should be. And then we also know that we're on the sell side of that curve. All right, so it's Monday. Now, of course, Monday was a bank holiday, but that's beyond the scope of what I'm trying to get to here. All right, so the very first thing, let me also put on the Asian range. Perfect. Good. All right. So let's look at the current range, and I want to outline the PD arrays. All right, so if this is my range, I'm looking at this range of price. All right. And this here is a rejection block. All right, we have a rejection block. We have old highs. And then obviously this is an order block. All right, so if we were measuring that range, looking at our PD arrays, These would be all of our premium arrays. All right, order block, rejection block, old high. Okay, everybody clear on that?
Clear.
All right, so down to a 15-minute chart. All right, now we're already inside of the order block. All right, where the central bank dealers range is. So what I'm going to do is I'm going to be measuring my central bank dealers range. All right, and honestly, wait, let's go back to, have to make sure that the criteria was set. All right, so on this day, we would have to use flout. All right, because the reason we'd have to use flout is because central bank, and this is borderline, so we're probably still going to use it. But for the central bank dealers range, right, to use those standard deviations, it needs to be 15 pips, at least 15 pips. All right, the Asian range needs to be at least 20 pips, no more than 40. All right, I think I want to say CBDR is maybe 30 or 25. I'm not completely sure. I'll figure it out for you guys. All right, but most of the time this range of price doesn't really expand too much unless we have like a maybe an FOMC where it has a liquidity void, and then maybe 4 p.m. starts trading back. All right, but we'll pretend that we're just going to take the central bank dealers range. All right, and it's 14.5 pips, so I would probably still elect to use it on this day. All right, now what I'm looking for once I use this standard deviation, okay, because I'm a London open trader, sorry if you can hear my son, because I'm a London open trader, I want to see, right, if there are any standard deviation alignments with any of these PD arrays, right? So we're coming into the week, we're thinking open, high, low, close, okay? And I'm looking for PD arrays above market price that align with standard deviations. So right away, what I see is this rejection block is aligned with one standard deviation. All right, and typically the Judas swing will be at about 1 to 2 standard deviations of either the Asian range, CBDR, or flout. All right, now let's for the sake of understanding, let's pretend that we actually did flout on this day. So when we're doing flout, that is simply just taking the central bank dealers range and the Asian range, okay? And then you're going to do deviations basically from the midway point. It doesn't matter if you take the bottom half or the top half, right? It doesn't matter because it's gonna align out anyway. All right, so 0.5 is coming in right here. All right, and you have about a 5 pip buffer. All right, and sometimes I don't really want to go 5 whole pips. All right, maybe I like to keep it around 3, but from ICT, right, of course, he's the originator of all of this. He says 5 pips. All right, but we can see here, this is less than 2 pips. That deviation is aligning. All right, so that's if we were to use flop. Just place it back on central bank dealers range. All right, so let's also outline our two to, so 2 to 5 is London open. All right, but we know that we want to see it happen between 2 and 3:30. Okay, so here we are. It's 2 o'clock. That's a 15-minute chart. And I want to say this entry forms on the 4-minute time frame. All right, so I already know this is the only thing that I'm looking for. And of course, this is not anything new to you guys, but what I'm getting at is having a refined focal point. All right, because you know enough to where you could get enticed to want to trade every single thing that you see. All right, now we got to close the gap between what we know and our bottom line result. Okay, so I don't really need to explain the entry model. You see it right here, right? Entry would come here. All right, price trading to fair value, other order block forms, chain and state of delivery there. But entry would be here. So this very first entry, I believe this is probably a 1 to 10 or 1 to 8. All right, let's say we just went here with a 4 pip stop, right? I wouldn't be that greedy. I just protect myself up here. All right. And we're going to keep sight of the standard deviations from the previous day's central bank dealers range. So of course, this is Monday, and we get to New York, which was a bank holiday, and then price dies out. All right, so we'll play that out. But even still, if you were in and out and you took profits maybe at the central bank dealers range low, so 1 to 5, maybe you're attacking this low to 1 to 8. All right. All right, so we move into the next day. Now, the next day, right, central bank dealers range is only 7 pips. We can't use it. Asian range, right, is 25 pips. We're going to use it. All right, so I'm going to measure the Asian range. So let's take the bodies. All right, and you can take bodies or wicks. What you do is you just like you'll play around and you'll see if you get like perfect alignments. Right, so you see how right here, this is technically 2 standard deviations right here, but you see how that's perfectly aligned with 5. Technically that's 4. All right, standard deviations from the previous day. All right, so I would see that, and I'm locked in on that level. And then also what I would be doing is looking across price, which I'm not going to scroll because it's no man's land right here. But I would look across price and see if there's any type of array, which there is an order block or some type of fair value gap or something aligned with this. All right. So we're coming into the next day. Now, with this trade, I would understand we just took out a previous week's low, and we also tapped into a higher time frame array. All right, which is the volume imbalance. This is the level we were targeting, that 0.680 level last week. All right. So I would take all of that into consideration. It's the end of the month also, right? And you can see, yeah, we just talked about that alignment, right? You see this? Okay. So back down to the lower time frame. And I think this just creates that first low, and then we're going to run lower. Yeah. All right. So all of this, think about this move right here, right? You could have been enticed by this move. All right, but look at it. This, all of this is no different than seeing 7 a.m. create this. All right, this is being created by 1 a.m. And then we get to 2 right here. Do I really want to take this based off of price movement here at 1? And even if you do and you get stopped out, oh well, we stay back, we stay in the trade. All right, so price runs there, and then we go back down. All right, so where are we? All right, there's perfect standard deviations from one of these measurements. Let me go, maybe we go to full range. And so quite, all right. But what we'd be looking for is to see if we could get the perfect standard deviation alignment. Okay, and maybe something's off with what I'm measuring at the current moment. But when me and Matt did it, it was something that was perfect. You guys can go back and test it out and see it for yourself. All right. So almost here, right? When we take the body, so that body and that body for those 2 ranges, and then we can see price coming, not even a pip. That doesn't even look like a full pip. Yeah, 1 pip of this 3 standard deviation mark. Okay. All right. So now I'm already knowing that I'm looking to trade in between 2 and 3:30, right? With a little bit of hangover to maybe 4 o'clock. All right. And then you can make that judgment as to if you go beyond that based on what you get. All right. So all this is forming in the right time window. We can literally see the entry model right here. All right. We engineer stops. We take out the liquidity. Am I recording? All right. All right. We engineer stops, take it out. EFD, OBV come simultaneously, right? And then here we are, right? Entry. And maybe I may play around with the stop here, or maybe I just come all the way under that low. All right, so let's say we play it conservatively. All right, we would of course take profits here at a premium array, somewhat relatively equal highs, right? And there's no way we can't say, hey, yeah, I would hold that trade. All right, so this trade gives us a 1 to 2. All right, or if you were very aggressive with the stop, then maybe, you know, maybe you get a 1 to 3. All right, but let's just say 1 to 2. Let's just go for the low ball number here. All right, so already, all right, realistically speaking, if we took profits here on this day, so that's 5R, 2R, that's 7R for the month, not the month, but for the week already, because I have a set and strict focal point. All right, so then we come to the next day. All right, Wednesday. Central bank dealers range, Asian range. Guess what? This is a day where London trading is basically taken off the menu. All right, you don't want to trade London open on this day. All right, very huge Asian range. All right, central bank dealers range doesn't even meet the criteria. Now, what you do is you take flout on this particular day. All right, we can measure the flout range. Let's go full range, and then we'll go 50% here, and then here. All right, or did I just do that wrong? All right, so Asia, right? Asia does not have doesn't give us the model, right? So 2, 3, 4, right? So we don't get a trade in Asia, not Asia, but London, because Asia is a pretty huge range. All right. Now, once we go and we look at the New York stuff, what we can see here is this is the first day that New York actually gave us the model for New York, which is we would simply just be waking up and looking for an optimal trade entry from London's expansion, which the London range and the previous day's range would be our look back function. All right. Now, I didn't go over the details for New York, but if we were doing previous day's range, right here, we're trading between 8 and 11 with about a 30-minute hangover to 11:30. All right. Price runs back up here, and our entry model forms in here. We just had 8:30 news on this day. All right. But as a New York trader, I'm waking up and I'm looking for optimal trade entry. All right. Guess what? We didn't get it on this day. We didn't get it on this day. This day offers. Let's actually go down here to this entry. All right. So we have EFD, order block validation, and then propulsion here. All right. Now, of course, yes, I know this is news. We're not putting on risk during news. All right. But this would be our stop here. All right. And then we could take profit here. Now, if we didn't take that trade, guess what? We're still looking for optimal trade entry for New York. All right. This is an optimal trade entry here. Price trades to that OTE point, and then our entry literally comes EFD, order block validation, and then propulsion is right here. And then that 0631 level is still what that was the target. All right. So 0631 right here. 0631 is where those equal lows come in. Well, now it's equal lows, but it was just one low previously. But if I'm waking up, if I'm a New York trader and I know that I'm waking up every day and I'm simply looking for OTE, and I'm looking back at a previous day's range, or I'm looking at London's range, which on this day, I would know that I can't use London's range. All right. Now I'm going to use the previous day's range. All right. Then now I'm up 4R for an optimal trade entry in New York. All right. For the week. So price trades here, and then we'll just cap it off. We'll say 4R. All right. So didn't mean to jump ship, but already we're at 5R, 2R if I'm a New York London Open trader. Don't get OTE on Tuesday if I'm a New York trader. I don't get to trade on Wednesday if I'm a London Open trader. But guess what? New York trader, right, shows up for work. All right, with 4R. Let me let it be.
Hey, Chris, you're gonna go over New York specifically, right?
Yeah. I'll go over it specifically. Let's go. Let's finish off for London. All right. And even last week, I would encourage you guys to take this, go back test London and New York for last week, and just look at how refined your focus would be if you're only waking up looking for the same thing every single day. All right. Maybe it comes one time out of that week. Maybe it doesn't come at all out of that week. At least you know at some point throughout that month or that quarter it is going to happen. All right. So I'm a London trader. On this day, we're going to use the central bank dealers range. And then I'm also what I should be seeing, right, from a narrative framework standpoint, we can see this swing low starting to form, right? We could also see price runs through this inefficiency, all right? And we would be thinking, all right, this is the range, and we'd be thinking that price is going to run to stops, right? Hang on 1 second, guys. All right. So let me place this back on. Standard deviation. All right. So I'm taking the full range. 2 standard deviations here if I take the full range. And then if we come here, right, about 2.5. So, and let's not do this in hindsight. Let's see what these projections are actually aligning with. All right. So I would see these 2 standard deviations, right? Maybe we would see that is aligning with that 15-minute order block. We have this inefficiency here. Let's come back down. All right. And we're within that 5 pip window. All right, but let's keep it to about 3 pips. I don't want to go beyond 3 pips because at that point, that's like forcing it. All right. So we're seeing this, right? This deviation. Remember, typically the London will create the high or low of the day around between 1 and 2 standard deviations. Okay. And so we're just taking the full central bank dealers range because the bodies well, I guess here we align with that inefficiency to some degree. All right, but you guys get the point. When I'm waking up, I'm looking at London. I'm only focused between 2 and 3:30. All right, but I have a little bit of hangover to about 4 o'clock. All right. Now that doesn't mean that if you get IOFC at 4:15, you can't take the trade. Like, don't be a robot. Make it make sense. But I'm just saying, let's have a focal point. Let's have a set time that we're coming to the market and a set time that we're leaving the market, and not being attached to if it didn't happen in my time window and now I'm going to go and force a trade. I'm going to deviate from my plan and force a trade on a shift that I don't necessarily trade. All right. So entry model comes here. EFD, right? OBV, and then propulsion is bingo right here. And then, we're safe. We should be safe right here. All right. Now, this is in hindsight. Of course, how do you calculate risk here? You don't officially know where price is going to trade to. All right, because I don't really see any equal highs or anything like that. All right, but we did understand from over here that price closed in that 1 hour inefficiency. All right, so then maybe we're aggressive and we attack stops. Okay, or maybe we attack 1 standard deviation. I think this aligns with an inefficiency. All right, the 3 standard deviation aligns with the high up here. All right. But that's hindsight. So let's keep it realistic and say that we were attacking this high. Okay. So that's 3R. So I've traded Monday, Tuesday, didn't get anything Wednesday. Was lucky enough to get another trade on Thursday. So I'm looking at 5R. This day gave me 2R, and I managed to make another 3R. So that's about 10R, all right, for the week. And I have none of it was random. I wasn't throwing blank darts at the chart. I'm waking up and I'm looking for the same thing, the same pattern every single day. I'm using the same system every single day. I'm looking at my standard deviations. I'm looking to see if they align with premium or discount arrays. And then I go apply my knowledge of framework bias and things of that sort. All right. And then when it comes to targets, if you start seeing these projections align with a high or another day's standard deviation or something of that sort, then that becomes a highly probable point for price to reach to. All right. Let's go through Friday. All right. So Friday is not even close to being permissible for either of those ranges. And so we'll still take flout, but just looking at that is probably something that you probably wouldn't even want to trade anyway. All right, let's take the 50%. You can see the high comes in at 1.5 standard deviations. And move this, all right? And you're not going to get a lot out of that. So we would just cancel that out, all right? Because both of those ranges are too small. And it's Friday and NFP, and then price just drops off. All right. So on this day, you're looking for a Judas swing between 2 and 330. I personally we wouldn't be trading this day. If you think about this profile, what is this profile? Range to a raid on news release, right? Or it's the consolidation to raid on news release, right? So this NFP, you shouldn't even be trying to force yourself to trade that day anyway, all right? But what I just want you guys to see, by having that focal point, right? And you can take this and you can go and back test and just, build confidence in yourself to have this same approach, to start creating this same approach for yourself. All right, so now let's talk about New York. Is everybody clear on the London stuff?
Yeah, all clear.
Okay, perfect. All right, so New York, right? From a New York Open trader, all right, New York Open kill zone, right? Of course, we know New York Open starts at 7 a.m., right? And we're going to use that 7 a.m. price to our advantage. All right, we're going to use 820. We're going to use 7 a.m., 820, right? And then, we know 9:30 is equities open, so we'll see some things happen there also. But we're going 8 until 11, right? And then we still have that 30-minute hangover to about 11:30. All right, stage is the same. All right, the stage is the same, right? I'm not going to write all of that. Higher time frame, institutional order flow, weekly range expansion, and pretty much the same idea here, right? Monday through Wednesday, of course, those are the more highly probable days. All right, but doesn't mean you can't trade Thursday or Friday. All right, depending on the weekly profile. All right, and then I also want to know which side of the curve I'm on. Am I in the buy program or am I in the sell program? Okay, the pattern is optimal trade entry, OTE. All right. So that OTE is simply, say we have our midnight opening price. Here's midnight. Here's midnight here. All right. Let's say price opens. We see the Judas swing in London. London expands. New York, 7 a.m. opens here. Opens here. Inside of London's range. All right. So at this point, we know that this is a highly probable stage or setup to get that optimal trade entry. All right. We may see 7 come here. False move, only to set up for the optimal trade entry. Right. 820 maybe here. What you guys will notice, of course, 820. And don't even ask me why I'm saying 820, because ICT has gone from 830 to 820. He said both times over the years. I didn't create the stuff. I'm just going by what he says. All right. But you will see validity around that 820 opening price. All right. Let's say 820 opens here. And what we want to see, right? If we're already under the midnight opening price, right, and we know that there's no expectation for price to run all the way back above midnight open, we're going to use 820 as our measuring stick. All right. And then we see price run up here, rebalances the range, entry model may form, optimal trade entry. And then I'm catching that continuation. All right. The other scenario is, let's say that same idea. All right. We have the midnight opening price. And it's kind of like we saw a second ago. Let's say that this is the previous day's price action. Right. And then London doesn't really give us much. Like London is just a dead period. All right. But we can't use London. All right. So let me talk about this. All right. The look back. So every single day, of course, we're still doing standard deviations because we want to see if there are any alignments in terms of projections. All right. So most of the time when it comes to New York, you're going to use those standard deviations that you used for Asia or CBDR, and you're going to see, if London has not exhausted the average daily range, right? And you can kind of gauge how much price has been moving. But if it has not exhausted that, then we know that New York has a very high likelihood of basically fulfilling that average daily range. All right. And so you can use standard deviation projections. Maybe that standard deviation aligns with the previous day's low, the previous week's low, or some type of array that needs to be hit. All right. So that look back function that we're going to use for New York is London open kill zone, right? The range from London open. And if London open does not give us what we want, then we're going to use the previous day's range. All right. Now, for all of these, we always want to be knowledgeable of our 20, 40, and 60-day look back ranges. So you always want to know where your 20, 40, 60-day highs and lows are. But more times than none for us as intraday traders, right, we're looking at that 20-day period, right? It starts there. If there's nothing within that 20-day period, then we go to the 40-day. All right. And we'll talk more about that in a separate session. Okay. So London open, can't use it. Then we go to previous day's range. All right. So I'm looking at previous day's range and I want to find my optimal trade entry, the potential for my optimal trade entry from there. All right. So this was Wednesday. This was actually Wednesday of last week. We didn't even have 8:30 news. All right. And of course, we want to, for both of these models, we want to be conscious of news, right? We want to be conscious of our red folders, our high impact news events. All right. So we didn't even have news at 8:30 on Wednesday. This is why I'm saying, hey, well, equities open, we should get volatility expansion. right? And we have news coming up at 10, right? So guess what price did? It ran to optimal trade entry of the previous day's range because we couldn't use London. Gave us our entry model, and then at 10 a.m., it dropped off. Took out the intraday low, and then we were still able to catch optimal trade entry from the London Open, not London Open, from the New York Open range. All right. So I would still be using 7 a.m. and 8:20. So let's say 7 a.m. was here. All right. And maybe my 8:20 opening price was here. All right. And actually what you're going to see on Wednesday is that 8:20 actually used, price actually used that 8:20 opening price as resistance and then traded lower. All right. So come in here. If we look at Monday, all right, Monday didn't give us anything. Fine. We know enough by now that it's going to happen. All right. If we look at Tuesday, expansions, all right, fine. We get to New York. I'm marking off 7 a.m. All right. This is the Q zone initiation, 7 a.m. All right. And what I'm thinking is I want to see protraction in the opposite direction of where I want price to go. And then I want to see price induce under the 7 a.m. opening price. All right. But this day was a dead day. We didn't get much. New York is off the table. Fine. We go to Wednesday. All right. So Wednesday, we're still thinking trade in line with the weekly range expansion. All right, because that 0.631 level is still there. All right. So guess what? I can't use Asia. I'm being conscious of these projections. I can't use London because Asia had a very huge range, and then central bank dealers range wasn't even permissible. Okay. So now I'm going to use my previous day's range because I can't use Asia. Now I have to look back to my previous day. PD array matrix, 1 hour chart, using this range here, premium and discount, optimal trade entry. All right. If I'm checking my news folders, I should be checking my news folders every day to know what I'm running into in my session. Right. No 8:30 news. News comes in at 10 o'clock. So then if that's the case, then everything that's going on should make sense. Right. And this is why it helps to have a set time that you're trading, because now you're becoming very familiar with this session. All right. So this is 7 a.m. Price begins to trade higher, then we just kind of go into a little bit of consolidation. This is time distortion, right? Time distortion. Price is purposely holding itself. Equities open right here at 9:30. And what do we see at the 9:30 candle? We see volatility coming to the market, right? And of course, we know this is just a BS move. Entry model forms. Go back to it. I know we already saw it. Entry model forms right here. All right. So let's just imagine if we didn't have news, right? Let's just pretend we didn't have news and we actually enter here. And honestly, to be honest with you, I was watching this and the entry model actually formed right here. This 2-minute chart. All right. So maybe you take this trade, we're all different. Way we manage risk right here may be different. Let's say we go right here with 8 pips. Right. This is your trade. You be attacking this low. All right. Maybe you had the standard deviation projections from Asia to see if Asia may have some type of alignment with that 0.631 level. So let's take the bodies. This 2 standard deviation. 3-1 comes in here. Let's take the full range. All right, 1.5 standard deviations. Let's see how perfect it is. All right, there we go. We are 1.4 pips. All right. So then maybe you leave a piece on because you're attacking this alignment here with the standard deviation projection. All right. Now price doesn't get there. All right. But we're already at 1 to 3 and a 3.5. All right. And then if let's say you did take that trade and you were patient and you waited on this one, 2-minute chart, this one actually gives you the better RR. 7 pip stop, and price runs here, and now you have a 1 to 4. All right, so you got a 1 to 4. You didn't trade until Wednesday. Let's progress through the week. All right, and then after this, we'll look at maybe 1 or 2 more from last week, and then we'll talk about balanced price ranges. All right, so same idea. We should be seeing this range. Price closes the inefficiency. Gonna run out stops. All right, it's the beginning of a new month. We should be thinking open, high, low, close. So we're already anticipating higher prices. Short-term low, intermediate. London forms the other short-term low. Big fractal. All right, well, guess what? Optimal trade entry, New York. 8 to 11. We'll go to 11:30. Let's go on a 5-minute chart. I already know what I'm looking for, right? I've decluttered my mind. 7 o'clock, 7 a.m. open, little inducement above this high. So 7 a.m. open, little inducement above that high, and then we rally lower, right? Optimal trade entry from this range. All right, and then this is also a dealing range, right? That high, that low. Blending the concepts. Right, create that low at 8:15. Guess what? We don't really have to use 8:20. Why? Because price already dropped back under the opening price. Okay, if we go back to Wednesday, we needed to use 8:20. So let's go, it's 8:30, 8:20 opening price. Look at that. 8:20 opening price. Right to the pip. Damn, 8:20 shows up for the next day also. All right. All right, so this is New York, right? Here you go. Entry model, EFD, OBV, PPB is here. And let's do projections from the standard deviation of the central bank dealers range. I don't know if this aligns with anything. All right, so you already see the 4 is aligned. All right, bingo. All right, and that is basically the high of the day. Okay. So that is how you, from here, everyone should be looking at this and deciding what their role is each day. 4R here, 5R here. Right, and this is in hindsight, of course, but even if you just took profit here, right, 2.5 standard deviations is aligning with this high. All right, it's not a random occurrence. So you got 4R, 3R, 7R for the week. Friday is NFP. We can relax on that day. All right. So I'm waking up and I'm looking for a specific criteria every single day. I know what the pattern is. I know what I want to see. I know what my look back function is. I've simplified my approach. All right. Friday on this day gave optimal trade entries. All right. We couldn't use Asia. So we use a previous day's range. When I say previous day, right? That doesn't mean the previous day, right? It means a previous day. All right. So what it means technically is when you say previous days range, that means any previous day within a 20 day period. All right. So we can't use London, right? Well, we look for previous days range. Our time window is 8 until 11:30, right? Typically 11, but we have that little hangover. Optimal trade entry forms. All right. So you have this one, right? Price trades lower. Look at what it does to this range from here to here. Imbalance is negated. This is a market structural shift. Market structural shift, we anticipate a retracement. All right. Maybe you enter from here also. Price trades lower. All right. At least I know what I'm looking for each and every day. All right. Is everybody pretty clear on that? And then you can see here on Tuesday, right? Optimal trade entry in New York. Tuesday, London Open gives you your trade, right? Judas swing. Okay. Not really sure what to say about that day, but you guys can go back and you can back test this based on the things that we've just covered. I've just learned how to share this page as a PDF, so I'll upload this to the main channel for you guys to look at. All right, so let's talk about, but first off, does anybody have any questions about that?
Yeah, I got a question about the previous day's range. So you said
Okay.
you're not using like if the previous day gives you clarity, like the one example from Tuesday to Wednesday, then use
Mhm.
that. But if you don't get clarity, then you just find any day within the 20-day look back or what?
Yeah, so of course now we're, at this point, we're all of us should be more advanced to understand it's not just gonna be any day, right? You're gonna of course use your understanding of narrative, right? PD arrays, um, up close candles, down close candles, all right? But what I'm getting at is if I can't use London, well, I already know what the weekly range expansion is, right? I know what side of the curve I'm on. Make it make sense. All right. So if I'm looking at this, very obvious, this is my range. This is a breaker. Well, technically, this is also a dealing range. All right. See where I'm going with this? Does that make
Yeah.
sense?
Okay. Yeah.
Yeah. Yeah. So it's kind of like this here, right? This is New York, previous day's range, optimal trade entry is up here. All right. You have to, you sometimes you'll have to do a little bit of dirty work, right? And either it makes sense. If it doesn't make sense, then stay out of the trade. There's nothing wrong with missing a trade. I'd rather miss a trade than put on risk and then lose capital. I guarantee you can recover a lot faster from missing a trade than you can from taking a trade that you chased or tried to rush into. All right, cool. Let's talk about this overnight session thing. But first, before we even talk about that, let's talk about like balanced price range. Let's revisit that. Mm, right. All right. So what I'm gonna do is I'm gonna draw out price action within this box. All right. And we're gonna determine if that price action has been efficiently delivered or if it has not been efficiently delivered. All right. So let's imagine price, this range opens here, trades here, here. All right. Which range is efficiently delivered and which range is not efficiently delivered? Anybody?
Yeah, it's tough. I would say left side.
Left side for what Chancellor?
Uh, efficiently delivered.
Perfect, right? And I know they kind of look similar, but there's one distinct piece. All right. So consider like if the market wanted to be fair, right? I mean, if it wanted to be fair, consider it pairing up here, this delivery with that delivery. All right. And wherever we can't see this, right? And of course, we're not, we understand to look beyond the scope of candles, right? We're seeing delivery. If we can't see that every step of the way, then that means that a portion of that range is not efficiently delivered. All right. So let's try to take this. Maybe it won't let me do it. All right. I'm not even gonna do that. All right. So here we are, right? Sell side offered, buy side offered, right? Sell side offered, buy side offered, sell side offered, buy side offered, right? We had a bit of an inefficiency, but it paired up, right? Sell side was offered, buy side was offered evenly. Sell side is offered, buy side is offered evenly, right? So on and so forth. We come over here to this range. What we see is a bit of a discrepancy right here. All right, so this goes beyond the scope of just saying, yeah, it's a fair value gap. Duh. It's a little deeper than that. All right. So because you can have a range that is efficiently delivered, yet still have a fair value gap within that range. Okay. And it's for the sake of the image that I'm trying to get you guys to see here, right? Everything is paired up. Okay. So let's look at go to I say I'll put on the overnight session with this GMT. All right. All right, look at this range of price. And looking at this range of price, sell side, buy side, sell side, buy side, right? Sell side, buy side, sell side, buy side, right? Efficiently traded, right?
Yeah.
Okay. So now, when price leaves a balanced price range with speed, as we're seeing here, right? When it leaves that balanced price range, okay, typically we only want to see price return back to fair market value. And fair market value just means, ICT has mentioned this, it just means that it's not really a premium or discount, all right? But the logic with this is that if this range is balanced and then price leaves this range, it's really not concerned about, shouldn't be, if this is true direction, it really shouldn't be concerned about the stops back above this range. All right. At most, it comes to fair market value or equilibrium of that range. Okay. So I took a paper trade on this Friday because I'm using the logic and I'm seeing what's going on here. Leave the range with speed, right? And we're coming back up here. And this candle opens at some 820 opening price is going to be somewhere within this candle. Let's find it. All right. Okay. So 820 opening price is here, right? We trade up around equilibrium of the range. We induce this high. We take out stops. And then just using the logic, the entry model forms right here. All right. EFD, OBV, and then propulsion is right here. And then what we take from there are projections of that range. And typically price will go to 3.5 standard deviations, right? Which you see here. So 0, 1, 2, 3, 3.5. All right, Friday stops at 1700. Right here. All right. So 3.5 standard deviations is almost where the low of day is capped off from this range. All right. 2 standard deviations aligns with that 4-hour inefficiency. See that? Okay. So keynote from that is when price leaves a balanced price range with speed, as we see here, we'd only want to see it come back to around equilibrium of that range before it reaccumulates and trades out of that range. All right. Prices to do something like this, then we would expect lower prices, right? Still using equilibrium of that range. We're going to see examples of it. All right. If you look at this area here, this portion here, right? So that wick doesn't really pair all the way up. All right. But we have basically there's an imbalance within here. All right. Inefficiently traded right in here. And then we actually come back the next day and we reach down to that point. All right. To reach back to this level. All right. This range here, you can see this range is efficiently traded, right? All right. Everything is paired up. All right. So cool. When price leaves the range with speed, where does it come back to? Equilibrium. Reaccumulates, and then it trades higher. All right, and then we go to 2.5 standard deviations. Okay, here's another example here. All right, this range of price is certainly not efficiently traded. All right, and then guess what? Price reaches back lower to come down here. All right. I want to take you guys to NAS. Let's look at this example. All right. So buy side offered, sell side offered, right? Price comes back up only to this point, offers buy side, and then we trade off. All right. So what you should be seeing from this is I can look at this range of price. All right. I can see if this range of price is balanced, right? Or if it's not balanced, and I can use that logic to my advantage. Okay. We only trade up to this point. Going back over here to this one, this range, buy side and sell side is offered within this range, right? This is a balanced range. All right. So if price leaves the range with speed, then we would anticipate that it really shouldn't go beyond the equilibrium. I'm not going to say that it shouldn't deliver beyond equilibrium, but we would want to see it come at least to here and then redistribute back lower. All right. And of course, you're still going to apply your PD arrays and things of that sort. If we look here, this is a dealing range. 1, 2, 3, and then we're out. Okay, let's go to NAS. Okay, so another key point is with this range, all right? So everything here is balanced. Okay, now price is exiting the bottom portion of the range, but is it leaving the bottom portion with speed? No. What's happening? It's forming rejection blocks. Well, look at this. Starts to reaccumulate at the equilibrium point of this range. All right, I believe the entry model shows up. Yeah, entry model shows up. All right, reaccumulates, entry model shows up, and we're out to the races. All right, and then you can also see the dealing range that forms. 1, 2, 3, boom. All right, let's place the standard deviation zone. What time does the stock market closes at 4 p.m., right? 16. All right, cool. All right, so we see price push to 4. Let's see, that would be 1, 2, 3, almost to 3.5 standard deviations of this range. Let's go back again. All right, so here we are. Balance here, balanced at that point, balanced at that point, runs through here. All right. Now, right to here, we're not really balanced. All right, so market takes out the low. This is when we get to the 815 macro, we take out the low and then we trade up, right? We're balancing here, and then price starts to reaccumulate at this point, and then we trade out of the range. All right, but what happens is we trade out of this range with speed, right? And then that speed is not necessarily sustained. All right, so it becomes an indication that price is going to trade lower. So imagine price trading through this side of the range, then this side of the range, right? And this range is balanced at this point. All right, but this has to be a sign that you could take advantage of this to go lower. Okay, and of course, everything is not always going to be textbook. We should all understand that by now. All right, here's an example. Is this range efficiently delivered? No. Look here. All we have is buy side. We open. Okay. The entry model is here also. All right. So maybe you take this entry understanding that price is going to rebalance, or it needs to rebalance this portion of the range. We're opening in premiums, right? Because the next macro is opening in premiums of this range, and then price attacks this. And look what happens. Once it exits, we're going to take the equilibrium point. All right, and we come just shy of the equilibrium. All right, right here. All right, and then price trades lower. So this becomes more of an advantage, even more of an advantage when you are when you're trading indices. All right, using this macro or making this macro come to life. All right, there's obviously something down here. 3 standard deviations, 1600. All right, cool. Is this range efficiently delivered? Buy side, sell side, buy side. Right? 815 macro. balances this price range, right? Just imagine if this is a down close candle, this is an up close candle, right? Well, this down close candle, it pairs up. So now this is balanced, right? Buy side and sell side is evenly distributed. Once it's balanced, price reaccumulates around the equilibrium portion, right? And it trades higher. It trades higher to 3.5 standard deviations, right? This is 1600. Market high comes in at 3.5 standard deviations. Let's go to this one. Same idea, right? Range is not efficiently traded. You exit here. All right, no speed exiting this range. All right. And then we have this little inducement of that high, and then we trade down, and then we basically deliver price efficiently for this particular range. All right. So let's move this out of the way. Okay. So we come down into here. All right. If you look, this is all buy side delivery. Let's go to a 5-minute chart. Damn it. All right, sorry, I screwed that up. Let's look at this example. All right, this range, right? This range is efficiently delivered. Up close candle, down close candle, up close candle. Right? But just imagine if these were candles and you were seeing these candles pairing up with one another. Right? So that range is efficiently traded. There's really no reason for price to need to come back to that point. All right. It leaves, but even when it comes back, there's still some validity as it responds to the equilibrium portion of that range. All right. Here's another day here. Buy side and sell side being offered. Buy side and sell side offered. Sell side is offered. Pairs back up. All right. Only sell side offered. 8:15. We have this bit of a gap in here. All right. 8:15. We run out those stops. We come back in the range. All right. And then price redistributes from this portion. Okay. So I know it doesn't. It comes maybe a point or 2 points shy of that low. All right. But that could be broker to broker. And of course, it's not always going to be perfect. But if that range is balanced, then we're going to be watching around that equilibrium portion and using that to our advantage. Okay. Another example here. Buy side and sell side, sell side, sell side, sell side, pair it back up, right? That range is efficiently delivered. Guess what? Equilibrium. We reaccumulate around equilibrium. All right. Now, of course, I'm not looking at bias or anything like that. We're just simply going through these, but you would add market, whatever your bias is, narrative and things of that sort. All right. Another example, range is balanced. Comes back up here, down here, right? These, and it comes around the equilibrium portion. Okay, and it exits that range. Where it caps off at 9.5 standard deviation. All right, is this clear? Maybe it doesn't make complete sense right now, but it gives you a point of study. And if this is not applicable to you, right, then don't use it. If you've decided, hey, I'm a London Open trader, I don't need this. I'm a New York Open OTE trader, I don't need this. I'm just giving you guys insights. And this is not, what I'm showing you is not, this is not subject to just this macro, right? This is just delivery. All right. Using the macro is just adding time and price in one complete setting. All right. But what we're looking at is, this is just delivery across the board. All right. It's like GU. GU had a scenario last week. I think it's down here. Yeah, it's down here. And you can look here. This is balance, right? We leave that range with speed. Price comes back, reaccumulates at fair market value, and then it leaves. Boom. There was some examples on EU that there were some examples on EU that had nothing to do with this, but you can look here. So looking at this range, right? This is obviously this is not officially traded, all right. But even if I was not looking at that, let's go from the scope of just candles. Right, carries back up, and then it leaves. Say something up here. I'm just trying to find something that stands out for teaching purposes. Is this clear? Is it like evident to you guys?
Yeah, it's clear.
Okay, cool. All right, so I just wanted to put that in front of you. I think the most important piece about tonight is just basically defining like what you're gonna wake up and do. And taking that, and of course, we're all unique. Maybe you tweak it to your own liking. I've just given you foundational pieces, but honestly, I think the foundational piece is good within itself. If you wake up every day between 2 and 3:30, looking for the same thing. Wake up every day between 8 and 11:30, looking for the same thing. And it's gonna happen at least once per week. That one trade could be all you need. Maybe that one trade goes 4R, done. You leave out of the week feeling very good. Okay. Anybody have any questions? Man, you guys are quiet tonight.
For last time, I'm gonna ask, can you guys hear me?
Yeah, we can hear you now.
LOL. I've been talking and asking questions or
Yeah.
trying to ask questions and seeing if anyone can hear me.
Yeah.
Hey, in regards to the weekly expansion for you said trading with the weekly expansion. I think either one or two of those, gosh, my phone, either one or two of those trades wasn't in the direction of the anticipated weekly expansion.
But
So
the key point, not to cut you off, I'm sorry, but the
No,
key point was that we traded through, right? Remember Tuesday. So Tuesday we had already took out previous week's low, right? So in that regard, right, and Tuesday was when we had that London Open trade. All right. So if we've already taken out a previous week's low, the key point in that, if you caught it, was, remember, this was the end of a month, right?
Yeah.
So we're thinking low close, right? Beginning of another month, we're thinking open high, right? So that's why I said you can't be a robot. You have to take that and apply your understanding of the anatomy of a candle, power of three, time. All right. Now, maybe you say, no, I want to be super technical. That's fine. You stay out of those trades. You only trade with where you think the weekly range expansion is.
Oh man. Okay. Okay.
Is that clear?
Yeah, no, the low close part was literally, it just popped into place when you said that. Okay, that makes sense. Yeah.
Mm-hmm. Yeah, and that would be the only reason that so you have to remember, like, you got to know when you can bend the rules and how far you can bend them. All right, because nothing is going to be super duper textbook every single time. All right, you're going to have to, sometimes you got to be a bit of a wizard and know when I can bend rules. All right, and when it makes sense to bend rules. And this is a week where we took out the weekly objective literally on Tuesday. All right, in the London session. All right, so that was yeah, right here. So we're taking out weekly objective in the London session. All right, we had standard deviation alignment. Well, and we may see price trade higher, right? Or maybe since you're trading counter trend, you take the lowest hanging fruit right here. All right. Anybody else have anything? If not, we'll wrap that up. I'll make a separate weekly outlook video. And honestly, for EU, it's as simple as I want to see price run to these equal lows. All right. And then I want to see this sell model complete. We're still targeting 0.5. I just call it 0.5, 0.52 or 0.55. GU. I want to see, because GU has equal highs. So, I was trying to see this as a market maker model. Like, I don't know if we get like an open high, low close. This is what I would anticipate, where this high is creating our smart money reversal. All right. And then we come here, because we certainly have equal highs with GU. And I don't think that, if price is wanting to keep going lower, I don't think we engineer these highs. And this is a prime example of what I mean. Like, Friday will leave things like this to set narrative for the next week. Because Friday could have very well ran those highs up. All right. So I want to see, I'm still targeting that 227 level. That is where that standard deviation projection aligns from this swing point up here. If I look at a monthly chart, and we do have to be conscious of the fact that we're like inside of a monthly down close candle on GU. EU is a bit different. It's a little easier to read. And then DXY is also a little easier to read, but of course DXY will lead the way. But here we are right here. All right, where we responded to the opening price of that monthly candle. And so what I'm anticipating is, since we've traded into that inefficiency, right, and we saw, some bit of a rejection block form, all right, I'm seeing this as our short-term high, intermediate, and I'm thinking like, okay, cool, this is the beginning of a month. Maybe we're open high, creating a short-term high to complete that fractal, right? And then maybe we trade lower. All right, but GU is not the easiest to read because of that monthly, we're sitting at that monthly candle. All right, but when I look at this range from low to high, then what I can see is, we should be trying to make it at least to one of these levels. And then we took out this high and closed completely back in the range. All right, so that shows me there was no true intent to really keep going higher. I think if so, I think we would have closed above that candle. All right. So I want to be attacking previous week's low, and then that 227 level. Same thing for EU, and then I think DXY is pretty simple because we have these equal highs from a monthly chart. All right, and then what I really wanted to see was on the, so this is the weekly, right? Yeah. Looking at this, we've basically negated that inefficiency. All right, we negated that inefficiency, and it's the same ideas. For DXY, we want to think open, low, high, close. All right, so I'm thinking the next target for DXY should be pretty easy. We have this here, which aligns with the opening price of that volume imbalance, or the closing price, or the discounted price of that volume imbalance, and then 0.5900 is where we should see DXY run to over the next course of, I guess, this month or the next few weeks. But I want to think open, low, high, close. Not so sure about these. I think these are just false expansions, right? 1700 opens and then we just start trading higher. I think that's just a BS move, you know? So I'd look for price to come back down into here, maybe even taking out this low. This is equal levels. All right. So I'm not buying an expansion from this. Like, if I ask myself, what is the best case scenario? I want to allow myself under here. It's no different than last week. You remember last week, I came into the week and I'm saying, hey, I want to be a buyer under this 038 level. And we literally stayed above that level until I think this maybe Thursday or Friday. All right. Now we're under that level. We have more equal lows. I want to see price do something like this. You know, so maybe I look for lower time frame market maker buy model. All right. And that's not to say that Monday can't do that. All right. If it does, then we just adjust. So 0475, 0513, and then 059 is where we will see DXY run to, potentially. Anybody have any questions about that? Any objections? No? All right. Cool. Well, I'm signing off. Hope you guys found insight in that. I hope you take one of those session models, use it, and let's see what the results are from there. All right. Good night, everybody.
All right, man. Good night. Thank you.
All right. Yep.
Chris,
Yes.
I believe it's been 2 weeks. Are we scheduled for this week?
Yes. Yes. So we'll see. Well, of course, we had a Memorial Day last Monday. So I think we were supposed to go last Monday, or were we not? Let me turn the record on.
No, I don't think we were.
Okay. Yeah. So yeah, I'll see you tomorrow.